Ladies and gentlemen, please join me in welcoming Helmut Pastrick.
Well, thank you for that introduction, Fred. I'm not sure about the epic human and the bold explorer. I'm just an economist, so I'll do my best. Of course, the state of the economy, it's been very interesting times. Being an economist, living through the great financial crisis, the recession, and the various events that have unfolded since then. And now, of course, we have this very unexpected plunge in oil prices and all the ramifications associated with that. And have to be, of course, incorporated into our thinking and our forecasts. And I should remind you that forecasts are a moving target, and we revise our forecasts as needed, and we revise often, actually. So, but that's the nature of the business. And really, the state of the economy, I think, is improving, mainly due to external factors. The drop in the price of oil, for example, is a significant development that should lift economic growth in many economies, including Ontario and Canada. Well, not Canada in general, at least not initially. But the lower dollar is another positive development. And, of course, the U.S. economy is finally seems to be kicking into a higher growth rate on a more sustained basis, and that has very positive implications for Canada and Ontario. And for your area, you should see those positive spin-offs play out. I don't have a forecast specifically for the Kitchener-Waterloo area, but in general, I do expect to see improved prospects in 15 and 16, along with the Ontario economy. So let me start my presentation. I'll start with the big picture. Clearly, the oil situation needs to be addressed, and then I'll take a look at some of the other issues with the U.S. economy, and take a look at other forecasts for just in a very broad brush basis for Europe and Asia, and then Canada, and focus a bit on Ontario. Then I do have some information for your local area as to its economic makeup, its strengths, if you will, and its potential prospects. So let's start with the price of oil. This is a graph depicting WTI and Brent oil prices on a weekly basis. The latest data point I have here is late December. And as of today, WTI was around $48. Brent was, I believe, around 50. So these are at multi-year lows. Not as low as it was during the depths of the 08-09 recession, but that was a very special event. I mean, that was a huge drop in demand. This is not. As you can see by my caption, it's a combination of both demand and supply, but it's more supply-driven than demand-driven. And the analyses that I've seen so far suggest it's probably 2/3, 3/4 supply-oriented than the balance being demand-oriented conditions. So where bottom is, I don't know. This is like a falling knife. You know, it's not something you want to catch, if you will. Bottom could be $40, but all indications are there's no signs of stability at this point in the oil market. So it certainly will continue to drop until we see some news developments break the current trend. Commodity markets and other markets have a lot of momentum going in a certain direction until there's a break in the news flow, if you will. On the demand side, there has been some slowing in demand. This is a graph that depicts the global economy segregated into two aspects, the services sector and the manufacturing sector. So this is the most current indicator available on on the state of the global economy. And it's called the Purchasing Managers Index, and it's compiled from a survey of many companies in most of the main economies in the world, and it's aggregated up on a weighted basis. So it's a balance of opinion measure. Typically, anything above the 50 mark indicates net expansion. Below 50 indicates net contraction. Now, it's not a perfect relationship with GDP or industrial production, but it's pretty close. And again, it's the most current measure available. And you can see from the latest data points that there has been a slowdown in both the services sector and in the manufacturing sector. And in fact, there's a number that just came out, the flash PMI for China was actually, for manufacturing, was actually a touch below 50. So a lot of this has to do with the state of the economy in the emerging markets, China, and in Europe. Whereas in the US, we're seeing generally strength. And so this is part of the demand story that, for example, the International Energy Agency has downgraded its demand outlook on probably 3 or 4 occasions in the past few months, mainly because of the slowdown that we've seen in the global economy. And that has contributed to part of that oil price decline, but certainly not the vast majority. Just to remind you of the sort of nature of the oil demand. This is a graph depicting the amount of consumption in million barrels per day for the US economy, Europe, China, India, and Brazil. So taken at 3 points in time, 1990, 2013, you can see that for the US, their consumption has actually declined, as it has in Europe. But take a look at China, India, and Brazil, and those other emerging economies. So the increase in demand is really coming from that component of the global economy. And that's where the slowdown has occurred over the past several months. And of course, these economies, the emerging market economies, and that could have included others, these are the main ones that are really going to be continuing to grow generally at a faster pace than the advanced and more mature economies. And they will set the pace, if you will, for not just oil demand and prices, but also for metals, copper, zinc, iron ore, and other commodities. That's to accommodate their economic development and growth. On the supply side, we've seen the U.S. oil production continually increase. And of note here is that blue segment, North Dakota. That's the shale oil that's coming out of the Bakken reserves, shale deposits. And shale is a real game changer in the energy market, both in shale oil and shale gas. And in Texas, we have shale deposits as well, and their production is growing. Oil production from the Gulf of Alaska is actually declining, as it is in the North Sea. Has for a number of years. So shale is a new resource, and shale is very plentiful throughout really the world. There are plenty of resource shale deposits in North America, in Asia, China, for example. And over time, one can expect those to be developed and tapped into. In fact, I should have mentioned that the U.S. On this trend line will become the largest oil producer in the world within the next 3 to 5 years. The International Energy Agency has produced some demand and supply forecasts for oil at the global level, and this is their latest forecast. So one line represents the oil consumption or demand, and the other oil supply or production. And the green bars represent sort of the balance between the two. And as you see, it's above the zero line. That means supply is greater than demand, stocks are growing, and hence there should be downward pressure on prices as a result. And based on their forecast, they see this imbalance of excess supply continuing for most of 2015. And it's not until later in 2015 where you see that green bar disappear close to zero, and then presumably we'll see some stability in prices. Now their assumptions on the supply side assume that OPEC will not, or will keep production at current levels and not cut back. Now that's an assumption, that's a working assumption, and that may or may not hold up during the course of the year. Obviously there's a growing tension amongst oil producers. There's going to be a supply response. That would be very natural and to be expected. And we've already seen some of that. Some of the energy companies in Canada have announced some reduction in their capital spending plans in exploration development. So that's just the beginning. And it really depends on how long oil remains at these low prices, and it doesn't even go lower. Will it go into the $30 range? That's still conceivable at this point. But all it would take is really, for example, OPEC or Saudi Arabia to announce, okay, they're cutting back on production, and that would certainly end the price decline and probably create a bit of a rebound. But we'll wait and see on that. Just to show you how this was unexpected development on the price decline. So I'm showing you a chart here where you see the actual oil price. These are annual averages. And then the forecasts produced or shown by this report called Consensus Forecast, which was done in August of 2014. And you can see the blue line there. Expectations on an annual basis of oil in the $90 to $100 range over the next 5 years. Well, fast forward to December, the green line. So that same report. And the consensus is really, this is an average of about 25 to 30 economic forecasters, industry forecasters. So it's just an average of that. And you can see the downshift that has occurred. It's not surprisingly, as the spot prices declined, obviously the expectations have also declined. The futures market, I just put this up there yesterday, has also downshifted its expectations on the price, and of course with now at $48, it's continuing to edge lower. So where prices will settle in at is still uncertain, but clearly there will be a supply response, and prices will begin to firm at certainly a lower level than we've seen recently. But that's again a really surprise development. It's a positive shock though, and it's really a net benefit for the global economy. It's certainly negative for oil exporters, oil producers, but it's positive for consumers. It's positive for businesses. And again, for the global economy, it's been estimated it could add to growth. Now, it depends on how long prices remain low. If it's anywhere near this red line, we could see another half a percentage point on real GDP growth at the global level per year. That wouldn't be a surprise. That would be a reasonable expectation. But certainly some producers will have issues. One thing that this oil price decline has generated is currency market adjustments. This is the trade-weighted U.S. American dollar, so it's weighted against a variety of currencies. Canada is in here as well, but we're only about a 3% weight in this particular basket. And look at the sharp appreciation that has played out over the past handful of weeks. And a lot of that has to do with the uncertainty that existed that still exists, not just in the oil market, but also more in the geopolitical tensions, the Ukraine-Russian crisis, the Crimea, for example. And typically the U.S. is a home for safe haven assets, if you will, a flight to safety. And that would boost the value of the U.S. dollar. But it's also, again, the U.S. will be a net beneficiary of this drop in oil prices as well. So one economy one currency that's taken it on the chin is the Russian ruble. So this is the Russian ruble exchange rate against the U.S. dollar and the euro. And it's obviously plunged very noticeably. For Russian economy, oil is probably about 25% of GDP. It's, I believe, upwards of 60 to 70% of their exports. And when it comes to their federal government revenue, it's at least on the order of 20 to 35%. It could even be a bit higher. So it's a big deal, if you will, for Russia to see this drop in oil prices now. Of course, Russia also is facing sanctions. So that's another element that's playing out in this currency. Russia has considerable foreign exchange reserves, so it's not about to, go into a default or face a financial crisis at this point. It does have debt denominated in U.S. dollars, more so in euros. But at this point, it looks like it can service that debt for some time. Other countries, when you look at other oil exporters, Venezuela, Nigeria, some of the other African countries, they're not in such a good position. They have high debt loads, relatively little sort of debt service coverage, so we could see some issues develop in a handful of those economies. Just turning to the forecast for the U.S. economy going over the next 5 years, this is really becoming a much better growth story. The U.S. recovery so far has been below average, the weakest recovery in the post-war eras thus far, but we are seeing signs through 2014 of increased strength. Employment numbers have been good, been rising 250, 300,000 per month. We've seen some pretty good action on some other variables. Obviously there's noise in many of these economic high-frequency data, but in general, the trend has been improving. This expansion has a lot of room to grow. And I think this forecast I'm presenting here, it's again a consensus view, could even understate the actual path of the U.S. economy. There's considerable pent-up demand on the consumer side. Consider housing. Housing starts in the U.S. Running about 1 million units a year. Under normal conditions to accommodate population growth, household formation, and also pent-up demand, if you will, we probably should be running 1.5, 1.8 million per year. And sometime in the next 5 years, I wouldn't be surprised to see a breakthrough to 2 million units a year. Now, there's still issues in the economy and in terms of credit availability. You know, credit is cheap, interest rates are low, but credit is not readily available. It's not like the days of 2004, 5, 6, and 7 when it was almost like if you could walk, talk, and you could get a mortgage loan kind of thing in the U.S. So credit is still on the tight side, and that's also been part of the reason why the U.S. recovery has been relatively weak thus far. There's some other factors as well. Obviously, the high levels of indebtedness on households and government, and to a lesser extent, businesses also certainly play a role. And also, the U.S. is not a huge export or trade-oriented economy, and so it really was dependent on very much on domestic demand-driven growth. Just quickly turning to Europe, growth there is much weaker. And Europe has just gone through a year or two ago another recessions, and some of the high-frequency numbers that have come out for 2014, Europe was bordering on its third recession since 08-09. So growth is really struggling. Even in Germany, which was the stalwart of the European sort of growth side, is also somewhere in that 0 plus or minus range. Italy's in recession, France is in recession. One bright spot is the UK. UK's economy is growing, Ireland is growing, and believe it or not, there are actually some positive GDP numbers coming out of Greece. Now, granted, we're talking coming out of a very low hole, if you will, but there's still ongoing problems in Europe. There's certainly very tight credit conditions, high levels of debt. The real estate market is still generally down for the most part. Business investment relatively weak. And after all, when you have weak demand, businesses don't need to invest into more plant and equipment or capacity, so that's going to take some time, and probably typically a lagging, the last thing to come around. So don't look for much growth coming out of Europe for the next 5 years. I think it'll be in that 1%, maybe 2% range towards the end of the period. Turning to Asia, China is still the big story. There is a slowdown underway in China. The real estate sector has declined, housing prices have declined, new construction has declined. This has been ongoing for the past year or more, and for a variety of reasons. In fact, the authorities have previously tightened to prevent a real housing bubble, housing bust, if you will. But now they're beginning to sort of unwind and try to stimulate a bit of growth here. So their growth prospects, instead of being at the 8, 9, 10, 7% range, will be down into the 6% range. We have actually the IMF forecast is somewhere in the high 6s, but then generally slowing. China has seen its high growth phase, but it still has a long way to go. Its per capita GDP levels are still well below what we have here. I think they're around $8,000 per person, whereas in North America it would be closer to 30,000, 40,000. But so they will continue to ride up that economic development phase scale over time, and they are becoming a higher cost economy. Their labor force is shrinking because of that one-child policy that was in effect for all those years. So labor costs are rising, and of course, the general production costs, and that's another element to deal with. India is really probably will begin to overtake their growth rates there. They have a long way to grow when it comes to growth, and they're again probably on an accelerating pace. Japan will be stuck in this low growth environment for quite some. In fact, it has been stuck in there for really since the collapse in early 1990s. It's been in and out of recession several times, and it has serious structural issues: a declining population, shrinking labor force, it's a relatively closed economy, it has many structural impediments where market forces don't really can bear out to play in the allocation of resources. So, I think that forecast there is quite reasonable. We look at Canada. Canada's economy has really also been in a fairly moderate growth phase, 2% thereabouts. It depends on a particular year, but really we've been driven mainly on domestic demand. Our trade sector has struggled, although there's signs of life. Some of the latest reports we saw through 2014 did suggest that there was some uplift coming from the trade sector. But still not enough to really generate high levels of growth. The forecasts I'm showing you here are a bit dated on the consensus side and on the IMF, whereas my forecast, the red line, I just updated this and taken account the drop in oil prices. So I've downgraded my forecast for Canada by a couple of tenths of a percentage point down into that 2% range for this year, and 16 somewhere in that vicinity as well. Rising though. I do have stronger growth in 17, 18, and 19 playing out. So certainly when it comes to Canada in the short term for this year and to some extent into next year, it's the Alberta economy, Newfoundland, Labrador, to a lesser extent Saskatchewan, where we expect to see a slowdown. Certainly we should begin to see less investment. Production will probably follow as well. So the bloom is sort of off the Alberta economy, and we will see. And then of course we'll have some initial impact on Canada. The Bank of Canada has estimated that these plunge in oil prices would take about 1/3 point off GDP growth, so about 3/10 or so. Their new forecast is coming out next week, and we'll presumably have a new assessment based on more current oil pricing, and potentially could be a bit more than that coming out. My forecast for better growth in 17, 18, 19 is largely based on this relative to the consensus forecasts you saw. So my view is that the currency our currency against the U.S. will continue to depreciate. So I'm predicting here that the Canadian dollar will drop to 80 cents in the next 2 or 3 years. I'm not bold enough to predict a drop into the 70s, but I could see it happening. I think there's these significant trends and momentum in markets that just continues to go until there's something that breaks that trend. And I think the Canadian dollar is will continue to slide lower. We're at what, 84.5 or something like that today. So I could see it sliding lower. Partly due to the decline in oil prices. Also, over the next 5 years, I expect, of course, the U.S. economy to outperform Canada. U.S. interest rates at the short-term level will rise, even at the long end, and that interest rate differential will favor the U.S. currency and disfavor Canada at that point. I see it stabilizing in the next 3 to 5 years as our interest rates also rise. I expect to see the global economy also begin to be on the mend and be at a better place. Commodity prices, I think oil prices will eventually firm as well and begin to climb higher. I mean, there's always that supply adjustment will play out and will begin to stabilize and bring up prices eventually. So that's, I think, the main element of behind this Canadian forecast that I have. Interest rates, I'm showing you here the short-term interest rate. It's a 3-month T-bill rate. That's where the Bank of Canada operates, and I don't see the Bank of Canada move until early 16. I thought initially it would be sometime in 2015, but given the downgrade in the Canadian forecast due to the oil price decline, I pushed it into early 16. The U.S. Fed, as I mentioned earlier, will be moving probably mid-15. It could even be a bit earlier depending on the data flow, but we'll see on that. But sometimes, certainly the Fed has really set the stage for its interest rates increases to begin. Now, they are not technically tightening. It's not really monetary tightening. It's monetary rate normalization. I know that sounds like a bunch of cliches and jargon, if you will, but there is a difference. Recall that the U.S. is effectively at zero, and that's only a result of what happened as the financial crisis. And now that the economy is growing at a better pace, they've ended their quantitative easing, and they need to bring rates back up to normal. That'll take some time. It'll probably be 2 years or more to normalize rates. Monetary tightening actually occurs after rates have been normal for a period of time and the economy continues to grow and we see inflation pressures develop. Then the central bank begins to, wait a minute, our inflation targets are at risk and we need to slow down the economy, and that's what we mean by tightening. So we're not there yet. So the first round of increases in the U.S. and even in Canada, we're sitting at 1%, and that's far from normal. What I showed you in my graph over there, I think eventually will be at normal over the next 5 years. Then after that point, we'll begin to see potentially some monetary tightening, assuming economic conditions warrant that. Just turning to Ontario. This is a graph depicting Ontario's economic growth since 1994, and also my forecast for the next 5 years. I'm showing you 2 measures of economic growth. The blue line is real GDP, and that's the headline number that you often see quoted in the media. We economists, we focus on real GDP because we want to strip away the impact of price changes. We want to understand real or sort of underlying activity, underlying volume, underlying output. Prices can be increasing faster or slower, and that can often give you a misleading picture when you want to gauge these kinds of underlying trends. However, nominal real GDP, or the yellow line, is actually more relevant for most, if not all, businesses. So that's the real benchmark you want to look at. If you're looking at, well, how are my sales doing relative to the economy, you wouldn't want to use real GDP. You want to use nominal GDP, because you work in nominal dollars, not real dollars or inflation adjusted. So there I see as well a pickup in nominal overall economic growth, again lifted by the lower currency, the U.S. economic growth pickup. Without that, we would be stuck somewhere in that 2% range. If we don't see that pickup in exports as a result of the currency and the U.S. dollar, or sorry, U.S. economy, then we'll be stuck somewhere in that 2% range. So we really need to see that. And this is my forecast for the trade sector, exports and imports. So I see exports growing at a faster pace than imports, and the Ontario's trade deficit as a whole will disappear. We'll actually have a trade surplus based on those projections over the course of the next 5 years. And in fact, it will play out before that. And whereas the trade deficit has been a real, the trade sector will drag on growth, not just for Ontario, but for Canada as a whole, for the prior probably 10 years or so. Ever since the dollar was at 65 and moved to parity, the trade deficit emerged. Now, the other factors come to play. I don't want to suggest that's the only one, but certainly is an important element behind that movement. The domestic side of the economy, this is my forecast for Ontario's domestic economy. And economists, we break it down into four main segments. So household or consumer spending growth, residential investment, so that's new construction as well as renovations and a few other things thrown in there. Business investment and government spending, federal, provincial, municipal, all rolled into one. And again, all adjusted for price changes. And according to my model, we should expect to see, I think, a pretty still ongoing growth in the residential side. Business investment will follow, but also pick up. And the government sector, which has been, the red line has been around that zero mark for a period of time, or below. Eventually, I see that turning into positive. So the government sector generally in Canada has been a bit of a drag on growth when you look at it in total. And we've really been, the main driver has been basically personal consumption and to some lesser extent residential. This is I'll turn now to your local area, and I'll focus on the StatScan's definition of the census metropolitan area, so that's Kitchener, Cambridge, and Waterloo. It's about a population of about 490,000 thereabouts. Upwards of 500,000, sorry. So this is a graph depicting annual population, and also the blue line is the population growth, so the change in total population. So you can see where we've been in the past several years, a downshift into that 1% range after going, for several years around 2%. And these are taken as of July 1 each year. The latest available is only 2013. The 2014 number won't come out for another 3 or 4 months. These are the components of growth from 2001 onwards, again on an annual basis ending July 1. And we can break it down into 4 segments. Net international, so that's immigration minus emigration. And then net natural, so that's births minus deaths. And then we look at the provincial flows. The blue line is net interprovincial, that's flows between the metro area and other provinces, the ins and outs on a net basis. And then intra-provincial, that's movement between the CMA and other regions in Ontario. And you can see that it's the net interprovincial that has tailed off, it's in the negative area. Even net international is also downshifted to some extent. But you have positive net natural, and it's running about overall, you combine all this, it's running about 1% or so. And when growth picks up, I would expect to see the immigration and migration numbers also pick up. And because Alberta is now in a slowdown phase, lesser growth, that will likely mean we will see fewer people leaving here for Alberta for jobs, and I would expect to see those net interprovincial numbers turn upwards and potentially back into the positive territory, so that will lift growth probably into the 1.2, 1.4% range, maybe perhaps a bit higher. These are the labor market numbers for the Census Metropolitan Area. These are annual numbers from 1996. So total employment, and then the unemployment rate. Of course, what stands out is the sharp increase in unemployment as a result of the recession. So unemployment rates are now sort of back into a little bit closer to normal range, if you will. We can take a look at the growth that has occurred in employment by industry. And this is from 2009, starting from the recession year. The recession actually ended in Canada in the second quarter of 2009. I'm using data here on an annual basis. And so growth in jobs from 2009 to date, the latest available, so that there's the information, culture, and recreation sectors that was leading, transportation, warehousing, professional, technical science. So these are the percentage changes in employment growth since then. Your top employment industries, so the top 10, and just in sheer numbers, still manufacturing, retail, wholesale trade, and health and education, and finance, insurance, and real estate, just go down the list. But certainly manufacturing is clearly the single most important one there. We can also break out how important is each industry in your region. And the way we do that in regional economic analysis is create measures called, in this case, location quotient. So all it does is take the ratio, in this case, let's take with manufacturing, the ratio of manufacturing employment to total employment in the metro area relative to the ratio of the manufacturing to total employment in the reference case. In this case, it's Canada. And so anything over the 1, anything greater than 1 suggests that it's it's an export-oriented industry. So it services more than just the local market. Anything below 1 suggests it's more of an industry that services, again, the domestic market only. So here, obviously, manufacturing stands out. Education is also above 1, and the others they kind of expect would be more domestic-oriented. So that's just one rough first cut, and just to emphasize the importance of manufacturing to this region. We can also take it a step further and do some additional analyses on the same lines. And in this case, I'm showing it to you for manufacturing only, and from 2009 to 2014. So we can break down the growth that has occurred in the manufacturing sector into these components. We call that shift share analyses. And so the first component, so total manufacturing employment increased 6,000 persons, okay, in that time frame. And so to what extent can we allocate what's responsible for that growth, if you will? It's a very simplistic measure, but it's a first cut. So the national means simply, if the national economy grows, then presumably there's all industries up. And so that's an estimate of what the national share might be of that 6,000. The next measure is called industry mix. And that is a measure that says, okay, the manufacturing sector in my base case, which is Canada, grew at a certain pace relative to the national rate. And if that was to apply to your manufacturing sector, this is what would have resulted. In fact, it would have resulted in a loss of manufacturing jobs of 4,000. But it actually didn't. Your manufacturing increased 6,000. So then what's left is the regional effect. And that's sometimes called the competitive effect. So there's certain conditions in your market where manufacturing has outperformed manufacturing at the Canada level. And it could be for a variety of reasons. It could be due to competitive advantages due to agglomeration economies, wages, property taxes, or the like. Some competitive effect is causing that, resulting in your manufacturing sector outperforming Canada's manufacturing sector as a whole. Now, of course, when I look at the composition of manufacturing here in your area, I see less of the traditional manufacturing that we see in other parts of Canada. Less auto, less steel, less of that kind of traditional, and more of the high-tech knowledge-based industry. Certainly there is some of auto parts and the like, I understand, in assembly, but it's certainly on a relative basis less. And so the composition of your manufacturing sector is such that it does create and result in outperformance relative to Canada. Now, it is relative to the base I've chosen here. I've chosen Canada. I think I would like to also see these measures. How would it perform against the U.S.? How would it perform against the Great Lakes economies? So I haven't done that analysis, but when I have some time, I will. That would probably be also quite insightful. I can also combine these two numbers. To what extent, I've done it for all these industries. So StatsCan breaks out the labor force, the employment numbers by about 18 different industries using the standard classification system. And so I've constructed this graph where the concentration is on the horizontal axis, and high concentration, remember manufacturing was high. Some of the domestic ones are on the low side, like government services, health, so it's low concentration in your marketplace. And then in the vertical scale, it's the regional shift or the competitive effect that I demonstrated in the previous slide with manufacturing. Ideally, you want your industries to be in the upper right-hand quadrant, ideally. So you have a competitive advantage, they're highly concentrated, and so things just don't get any better, if you will. But you don't want to be in the lower left. So you want fewer industries in the lower left, more in the upper right, and of course you want to be above zero, ideally. That would be great, but that's rare that all industries are above zero. But in your case, most of them are. Even though they're not highly concentrated, or quote-unquote export industry, but they are. So your region has done very well. But I've conducted this same analysis for all the regions in Ontario. And yours, along with Toronto, stand out. All the other regions typically below and in the lower quadrants. So again, it has to do with obviously some competitive advantages in the industry makeup you have here. Just we can break it down a bit further as the type of manufacturing. The data comes from the StatsCan Business Registry. So they conduct this, it's actually from administrative databases, CRA accounts, T4s, and those kinds of things. And so this is 2 points in time, 2013 and 2008. And you see the type of manufacturing location. So StatsCan counts locations. So a business could have 3 locations, 5 locations in one entity. So these are the number of locations. That's the mix of manufacturing that you have. And these are the number of locations that, according to StatsCan, with employees. StatsCan also measures those what they call self-employed or indeterminate number of employees. They could have family members and others working. But these are locations with employees only. And you see the change that has occurred. These are the number of locations, 2008 and 2019, by size of or number of employees. And generally there's been a downshift, if you will, of larger manufacturing, and it's been relatively more in a smaller number of operations. And I think that's generally what we see elsewhere as well. Just quickly turning to other aspects of your economy, when it comes to non-residential investment, this is the private sector. These are both in current dollars and adjusted for construction costs, price inflation. So not much going on right now in the private. So this is commercial construction, retail, office, those kinds of things, as well as industrial buildings. So, but it does look to be stabilizing. This is the government sector. That big spike you see there in the last data point, that's the Cambridge Hospital that's now commencing construction. And so that'll obviously help keep those numbers up for some time. We have a couple other significant public-oriented projects of the University of Waterloo as well, on the books that'll show up. Just quickly turning to housing. This is the housing sales from the Real Estate Board. So a pretty good pattern, nice upward trend. You know, sales haven't really been getting out of into a strong double-digit territory. But a more steady rise. Low interest rates certainly help. You know, the economy has been pretty good. Population growth kind of on the downside and low. So it's mainly interest rate driven. And that's despite, you know, we have credit conditions are relatively tight. When you think of the changes that have occurred at the federal level, mortgage insurance over the past 3 or 4 years, so the credit is less available now than it was previously, and credit today, what is being extended is of much higher quality than it was before. The regulators have really come down on lending institutions, banks, credit unions, toughened up their sort of risk surveillance, and have imposed greater oversight and requirements, and there are more capital as well. So that's all resulted in somewhat less credit being available than before. Even though it's at a low price, it's still a bit on the tight side. Here are your housing prices. I'm showing you the average sale price in current dollars, and then adjusted for price inflation. So in this case, I'm using the Ontario CPI, or Consumer Price Index. If I could use one for CPI index for your metro area, it's just not available. But so for the provincial CPI as a sort of a benchmark against aggregate price inflation, prices have still been rising, they're at record highs. And, you know, it's all about land, really. Land prices continue to rise because of a variety of supply issues, not just increasing demand. I think someone once said, buy land, they don't make it anymore. Well, there's a lot to that, you know. And a lot of the price analyses I come across and read about housing prices being overvalued, extended, expensive, a lot of the analyses really ignores supply-side factors. You know, certainly they talk about interest rates, demand, and potentially speculative demand, foreign buying in some markets, but rarely do you see a lot of commentary and analyses on supply. And supply costs and supply availability, land availability, all are very important, and we shouldn't ignore the supply side. You know, economists, we're simple people. You know, we think of what? Demand and supply. So it comes down to pretty basic stuff here. And again, I see supply being underestimated, under-respected, if you will, just simply not taken into account as to why prices are where they are. You know, development costs, construction costs, they're not declining per se, they continue to rise. And again, land is scarce. You know, so that's going to continue to rise. In my view, prices in 20 years will be substantially higher than they are today. Just turning to housing construction, of course, that generally follows housing. So we have that spike. It's all in the apartments. I think there was some rental and condo apartments. So, you know, new construction can be somewhat volatile, but I think we'll probably see housing starts decline next year. Typically, when you have a spike, it'll unwind to some extent. It's sort of like beyond sort of underlying trends. But I think the 5-year forecast, I would have housing starts tracking your economy, tracking population growth, and generally rising. So that's some of the list of major projects I came across when I was examining your economy. The transit line, a couple of major construction projects as well. And transportation is very important. We need better transportation to facilitate the movement of people, goods, and the like. So typically, improved transportation enhances a region's economic performance. So here are my numerical forecasts for your census metropolitan area. Employment numbers, I see improving, unemployment rate declining, and also the housing market doing well, holding up. Did I ever tell you why economists present their forecast to the first decimal point? Well, actually, there are two reasons. You know, one reason is to give you the illusion of precision, and the other is to show that we have a sense of humor. I don't expect these results to come up to the decimal point. I hope I'm correct in my trend, and I hope I'm correct in the general magnitude. You know, if it's in the 2% range, if it comes into the 5% range, that would be a bit of a miss. So we should take these forecasts with a bit of a grain of salt. I do, so I think you should as well. But I do think the conditions are for improved performance, again, mainly due to external factors, and we need that. I think obviously there's more could be done at the local level too to ensure that we have efficient and productive activities. But for the most part, economic performance in Canada and its regions generally is improved when we have positive external conditions, and generally less positive when we have negative conditions. With that, thank you.